everybody's here, but Al sent me an email, said he wouldn't be able to attend today, but we still have a quorum to do business, so let's look down here. So the review and approval of minutes of previous meeting, I've reviewed those. I don't see any issues. Does anybody have any questions?
Let me call roll.
Didn't do that. That's fine.
David Brewer.
Here.
Adam Brannan.
Here.
Al Torrance absent. Daniel Dorn.
Here.
Regarding the minutes, do I hear a motion to accept and approve?
I'll make a motion to accept them and approve them. I'll second.
All in favor, say aye. Aye. Motion carried. Let's see here. It's kind of a new business. I think you probably saw this. I think between the time the agenda was written and us attending, the city council did approve and publish the ordinance to adopt the change in the payout methodology. So we probably need to contact her and see if she wants to make that election a change from the 10-year to more of a life annuity. So is city HR got to handle that retroactively, or do you know?
I don't know. I would confirm with them. They normally do, but we can.
Yeah, she did. We need to make sure she understands her options.
Do an email. Do you want me to do an email?
That'd be fine.
Okay.
And you can reach out to just, you know.
That's what I'm saying. Me or Daniel probably can reach out to her. Too.
Yeah. We just need to, it's got to go through HR because ultimately they're ones keeping the tabloid, so to speak.
We can explain it to her and let her.
Yeah,
she'll know what.
It's less money, but a lot more time. So.
Yeah, I don't know what the difference is. I remember you mentioned it.
Yeah, they've got it. Donna can give it to you. They did it.
Well, I think she'll probably give it to her. I'll just tell her it's discounted. So.
Yeah, it's the same actuarial number, but the difference is, you know, it's
The term.
the term.
Right.
Yeah, I mean, if you live a long time, you'll run out, you won't quit paying after 10 years, and then that could be a problem.
Right.
Because you know, people tend to live to the extent of the cash they have. So, yeah. So, all right. That's prior business, performance review and code.
You want me to go first,
Yeah.
or do you want to go Peter?
Either one you want to do.
Well,
Peter, you want to go? Doesn't matter.
Yeah, because I think he's going to consolidate everything, so
Okay.
we'll do this. Component.
Just a little bit of good news on this, I think.
Yeah. All right, here's our report. If you'll take a look at this, this is a bond, just an absolutely fabulous year. In fact, it's so good, it makes you shake your head and wonder how long this could continue. But on the inside of the first page, you can see that we started the fiscal year at 5.288 million, and we ended up the fiscal year at 6.884. We had the account appreciated 181,000. Everybody see that? There were distributions about 278,000, and there was income of about 75,000. So getting close to 1.9 million in appreciation or additions to the account. That's astounding. If you turn over to the next page, you see that works out to being a year-to-date return of 35.49%. Now,
Do we expect that every year, Peter?
not a chance.
Okay.
In fact, I'm at a loss to tell you what expectations should be. You know, I can look at the economy, and most of us can, and the economy looks very strong. The consumer is strong. Consumer is 70% of the economy, and there's no sign that that's really going to change. Business, recently they've had record profits. Inflation is not a bad thing for businesses. It gives cover for people to raise prices and add a little bit more. And why wouldn't you? And they kind of pad their margins. So margins are at all-time highs, which means the amount of they're making on each product or each service that they're providing. That doesn't look like that's in danger of going away anytime soon. There is a big bugaboo out there, and that is inflation. If it continues to accelerate and get out of hand, force the Fed's hand to start raising interest rates sooner, cooling off the economy, that's so that the market will respond to that very negatively. So will bonds. It'll be one of those times when there's no place to hide, so to speak, except cash. Don't see that yet, but it's something that we have to be very aware of and watch. Right now, it seems the Fed is on a steady as you go course. Some of you may not or may know that Fed President Jerome Powell may or may not be reappointed, but the other candidate looks very similar in policies. So we'll have to see what happens there, but I don't think that's the big thing. It's just simply what happens to inflation. As far as getting back to your account, if you look at that page, you see the last 3 months really didn't do too much. It was pretty flat. It was up 0.73%. And this is typically kind of a tough period anyways. You're talking about August, September have been historically weak months. They're not always, but historically it's not been a great quarter. But it was, the S&P was only up 0.23% during this period of time. You see we compare very favorably to the S&P. And any way you cut it, 35% in a year is just an astounding return. It ought to put your pension plan, I think, which has already been well funded, it ought to continue to improve wherever you are. As you know, that statement or that measure changes over time because as you add benefits, that you have to have more money. As well, the other thing that's happened is people's expected age or longevity has expanded, which means you have to have more money to pay them longer. So all those things factor into it, but I'm sure that it certainly didn't hurt. If you turn over to the next page and you'll see at the top, look what assets we had, about 133,000 here. I kept some because from time to time you do need some cash, and I hate to be in a position where I have to raise it during one of those periods where it's just an ugly period, and that has happened before. So I've kept a little bit here, and it hasn't hurt as much. In terms of the stock portfolio, we haven't had a lot of changes. The interesting thing about the stock market is this year, both growth style stocks, growth stocks did very well, and value stocks. It was kind of like a little bit of everything. Some obviously did better than others, and there were some disappointments here and there, but it was fairly broad-based. It was across the board. So if you were just in the market, you did very well. And again, we have a market that is not cheap. It's not crazy, but it's not cheap. It's a little on the expensive side. So we'll either work into it by earnings continuing to go up and moderate that somewhat, or we have a correction. And we do have corrections from time to time. So I just put that out there to be aware. We've been through several of them in
It's going
our
to
long
happen.
history. You know, usually the best thing to do is stay the course, not do anything stupid. Obviously, where it makes sense, raise a little bit of cash here and there, but not overreact generally is the best course. I can go through the various holdings, but would you like me to?
Have you bought any new ones?
Yeah, we have. Let me just go through a little bit, category by category. Communication services, it really didn't change. Disney has not been a good performer this year. It's we feel that it will be a good long-term hold. Continue to believe it's one of the premier companies in its category, something that you almost can't duplicate today. You may have heard that Facebook is changing its name to Meta Platforms, and they have aspirations of providing a much broader based digital service environment, artificial reality, whatever you want to call it. And I couldn't explain to you all the things that they hope to do in that new metaverse, but we'll have to see if it sells. In consumer discretionary, this is all the same. Some of these companies have done extraordinarily well. Amazon has done well. Garmin recently has been relatively flat. Lowe's has been exploding to the upside. Its new management team has done very, very well, and their earnings have been just superb. Target's earnings have also been superb. They reported the other day. Market actually knocked them down a little bit because they said, we're not going to raise prices, or we're going to hold the line as much as possible. Walmart did the same thing, which is interesting. They're basically sacrificing some margin potentially for market share. And I don't know, you can say if there's any other ulterior motive to it. Ulta Beauty has certainly come back. It held up relatively well during the pandemic, but it is coming back very, very strong. In consumer services, these are all the same. Not much has changed. These are all outstanding companies. We've been a little frustrated with Helen of Troy, but it's really acting well now and has come on. In energy, we have a pipeline company that's called One Oak. They have some very important key pipelines. Among them are some key pipelines in the Permian Basin. And they're not affected so much by the price of the product. It's just how much do you ship through their lines? You know, it's like a toll road. You have to pay to move product from here to there. And it's the cheapest way to move product. In financials, Bank America, BlackRock, Co-America. We did replace some time ago Wells Fargo with Bank America. I just felt, I don't know that it made a heck of a lot of difference, but we just felt more confident that Bank America didn't have all of the problems and the workouts that Wells Fargo does. JP Morgan, MSCI has been fabulous. They do a lot of indexing funds, especially in the international arena. Charles Schwab has done very well. In healthcare, these have all been here for a while. We did recently sell Teleflex. It just hasn't been acting well. We gave up on it. So that's now gone. In the industrials arena, these have been here for a while, but we did add over the past year some new names. Clean Harbors has not been there that long. Emerson has not been there that long. Parker Hannifin has not been there that long, and we added United Parcel. So these have all been real strong performers. In technology, we did get rid of IBM, and we replaced it with a company called DocuSign. And you may be familiar with it. We just think that that's not just a temporary thing. We think more and more paperwork is going to be done that way, where you just, instead of handing out paper, you just send people, you know, a DocuSign email and you sign it. If you bought real estate, your contracts are probably DocuSign. More and more things are going to that. I think that's going to be a worldwide phenomenon. We're not going to be pushing paper around everywhere. People, when they get it, they end up scanning it and putting it into an electronic file anyways. Why not just start there? So that's been changed. And then Keysight has been outstanding. That's a company that does a lot of specialty equipment for 5G installations, a lot of testing. Marvell is a semiconductor manufacturer. They have a number of key areas: Internet of Things, 5G, and cloud services. Microsoft, we've had quite a long time. It's been phenomenal. It's now over 300. I see we bought it back at $42 a share. PayPal, it's gotten a little bit controversial up here. People think that growth rates are slowing. We're looking at it pretty carefully, but so far we haven't decided to do anything. Tyler makes a lot of specialty electronics for a lot of heavy equipment. No, I'm sorry, that's Trimble. Tyler Tyler is the software that these municipalities own. You know, municipal accounting is completely different than regular accounting. And they make a lot of specialty software to do that, to handle court cases, scheduling, utility identification, where everything is, what's working, just a lot of different packages. And they are the standard among municipalities. Unity is not been there that long. And Unity is a company that started out making games, but then it developed a platform that is very useful for producing artificial reality or virtual reality. And the platform is more valuable than any games because everybody's using it. Facebook, when it's talking about the metaverse, it's using Unity's software to a large degree to create some of these services that it wants to create. Visa's gotten a little controversial. Just recently, they've gotten into a little bit of a spat with Amazon. And England, Amazon is saying after the first year, they're not going to accept any Visa cards. I'm sure this is about pricing. This has happened from time to time with cable companies and you know, certain entities or parts of their bundle want too much, or they fight over the dollars that are being brought in. So this is a fight. We suspect it will get resolved. Most of the new services for financial fintech companies still use the backbone of Visa. Zebra is basically logistics and all phases of it. And then Southern Copper is a copper miner. Anyways, you can see the cost basis as of this period was about 4.469 million. And the market value is about 6.884. I'll just take you through a little update since it's been a little while. This just tells you how crazy things are. It's been less than a quarter since the end of the fiscal year, and we're already up 8.74%. We've already added another 738,000 of this. These are not realistic numbers to expect going forward. This is kind of frothy. So we're a little worried, but we're watching the elements pretty carefully. And so far, so far so good. The problem with managing money like this is you just can't say, ooh, I'm going to sell everything and go to the sideline. I could have said that a year ago, and then look at what you would have missed. So it's tricky, but we're watching, especially inflation and the reactions to it, and we think that's a key. I handed everybody our latest quarterly newsletter. You may get it with an email, but I went ahead and gave you a hard copy. I write this every quarter. It kind of gives you our outlook. At any rate, does anybody have any questions?
Hey, Peter, could you do me a favor? You do a great job of coming every quarter and providing an overview of the portfolio, what you think on markets. It's been a while since you've updated the board on River Place and just the firm. So could you maybe spend a minute or two just talking about the firm, who the team are that are researching and picking the stocks in the portfolio?
Okay.
Just any changes that have gone on over the last little while?
Well, we've really been pretty stable. We added a operations person here recently. Her name is Annie Campos, and she handles a lot of the administrative functions of the firm. Terry Kimball used to do that, but Terry now does just finance, and this is in support of growth. I have a couple partners. You've met Scott Wohlers and Mark Ross, and the three of us, including Terry, constitute an investment committee, and we go through everything formally every week, every Tuesday morning, starting at 10 o'clock. We meet any other time we need to, but that's a formal review. We have a number of reports, a performance report that looks at our various composites, individual accounts. We go through everything. And then we have an attribution report that looks at every holding on every strategy that we have, what it's done in the past week, what it's done year to date, and the expectations, what have the recent earnings been. We review every one of those for every strategy. And then any general comments or just concerns that anybody might have, we discuss. But that's our process. It's a very formal process, but very adaptable. I mean, we can get together at the drop of a hat. That really hasn't changed for some time, Brad, and don't expect it to. Hope it doesn't. We've grown considerably. We don't think we need to do anything more right now. We will probably add another person in the next year or two. But right now, we feel like we're very stable. The one thing that we are doing that will be a little bit of a, it's just a lot of work. We're making a software systems change. This system that produces these reports and does all our accounting for accounts, we think has gotten out of date. It's very cumbersome and not easy to use. And there's another system out there that is a lot more user-friendly. It's all cloud-based. We're going everything cloud-based. This system resides on our own server.
What system are you going to?
Black Diamond. Okay. It's very well known, very good system. And we're leaving in data to go to Black Diamond. In fact, I signed the papers, DocuSigned them yesterday. That's going to happen. And they will start gathering all the data on a daily basis very shortly. And then as of the first of the year, we will be on their system. We'll run the other one in parallel, just in case. And then after the first quarter, presumably we'll be producing the new reports on their system, on the Black Diamond system, and not this one. But if something didn't work out or whatever, we will have the old system. So for a quarter, we will maintain both.
I love DocuSign. I never thought I'd get so excited about it.
Oh, it's,
It works. We use it.
Oh
yeah.
my God.
Charles Schwab, we use them as our major custodian. And, their account opening documents are all DocuSign. We just send them out. They come back almost
You have
immediately.
on that record.
Automatic. We weren't sending them out and scanning them in and keeping them electronically, but now you
You guys don't know what you're missing.
eliminate that
I'm
step.
excited about it.
It's just,
I've actually used it several times on different things throughout
Yeah.
the years.
They got a competitor that we use on some things. They don't have quite the monopoly they did
well,
a few years ago.
in that business, you really want to go with the big and the first movers, because they become kind of the de facto standard. It doesn't mean somebody else can't get in the little places, but once you become the de facto standard, that's what people use. That's what they're used to. That's what they know how to use.
It's just as their cost structure is a lot higher than everybody else.
Because, volume makes a big difference.
Yeah.
Yeah. So,
No, because it's because they have a monopoly on those.
but that's really our only anticipated change. You never know what's coming down the line, but the team looks very, very stable. And we're very happy with how things are going.
I appreciate you giving that.
Yeah.
Brad?
All right. Good morning. I won't spend a whole lot of time on the beginning part of this book. Peter kind of talked about what happened for this week here, but just if you want to see some numbers, page 3, give you a broader look at equity markets and fixed income markets for the quarter. So you can see S&P 500 was up a little less than 1%, 0.6% in blue. Small cap stocks, the Russell 2000 down 4.4. International markets were down a good amount. We don't have any of that, so it's a good thing. That was mostly led by China. China kind of went in, their government intervened in their private sector, and the big tech internet companies that have been very successful, Baidu and Tencent, basically said, you guys are making too much money, so we're going to put more regulation on you so you don't make as much money. So the market got spooked. So you can see emerging markets were down 8%, over 8% in the quarter. And then bonds were flat. bonds, there wasn't much change in interest rates. So bonds were, the aggregate bond index was up 0.1%. But you can see the 1-year numbers at the bottom right-hand side of that page. I mean, just fantastic. You know, S&P 500 up 30%, international stocks up 24%, and then bonds down 1%, given that rates rose a bit over the last year from a very low base. Remember, interest rates just collapsed during the height of COVID, and then we went up a bit. We talked about, these strong returns, and you see fixed income, even though it went down a little bit and rates rose a little bit, we're still, the 30-year treasury is less than 2%. I think the 10-year is at 1.5, 1.4, something like that. 6. There you go. So, I have, besides the performance report, if you remember, we have a real estate manager analysis. We tabled that last quarter. A few quarters ago, I presented an educational presentation on what that is, talking about expectations going forward, right? Return, your expectations should be lower. So right now, we've already taken a step and taken multiple steps over time to reduce our return assumption. It's currently at 7.55. In conjunction with the next time when the actuary comes, I'm going to get into the return, but we got 24% this year, and that's a good year to consider continuing to lower it. Because if, the way it works, if you lower your return assumption, all else equal, the city has to put a little bit more money into the pot now, with the anticipated benefit of not having to pay as much down the line. But if you can get a year where you're at 24% and you've significantly outperformed, then that's a good year to kind of basically offset some of that. So it's something that you're going to continue to consider. But part of that is, what are some asset classes that we can introduce that might get us more than our bonds? We want to keep some bonds in the portfolio. It's important to provide that protection of capital and the ability to, weather the storm that we know is coming from, corrections in the equity market. And that real estate is a very, very good idea, in my opinion. It's an area and an asset class that's being utilized by a lot of pension funds that can qualify for it. And you guys have grown to a point where you can now. And I do think it makes a lot of sense. Now, I know Al's not here, so I don't know if you want to table that again until the next quarter, but I really do strongly recommend that we try to take a look at this and potentially make a decision one way or another relatively soon here. Inflation, 6.1%, 30-year highs, right? Everyone talks about it being transitory, but if it's not, real estate is an excellent way to hedge against inflation historically, both from owning that land as well as the rents and the leases that you have typically will have some sort of escalating factor on an annual basis that adjusts for CPI. So it is, we think it's a great move from a long-term strategic asset allocation perspective, but also there's a timeliness factor as well that I think that we want to, do this sooner rather than later.
What's your guys' viewpoint on interest rates? I mean, we're kind of hovering. I said the market's kind of got an artificial 1.6, 1.7 ceiling on the 10-year. Do you guys feel it's got to move up some? In other words, it's got to inflation adjust because the real rate of return now is negative. So
yeah, I mean, I think that's kind of a consensus, right? It hasn't happened. Now, it's not even happening when you're posting inflation numbers of 6%, right? The rates aren't really adjusting to that, which is interesting. The one thing that when I think about it that concerns me is that you definitely have these short-term supply demand, like supply chain issues that are going on that hopefully will alleviate themselves in a relatively, and I say relatively, we don't know when it will, but let's say over the next year or two, that'll go away. But you're absolutely seeing wage inflation throughout the economy. You're seeing McDonald's offering, and this is without a government mandate, right? These companies are saying $15 an hour is the new rate. You're seeing, good luck finding a truck driver right now. So their wages are all going up. The port workers, they can't find port workers. That's why all these boats are. So there's a lot of nursing. I know, my wife's a doctor and everyone, go through the stress of COVID and dealing with all that, as well as so a lot of people are leaving. And then you have this factor where a lot of younger nurses can just travel. So that they're filling in the gap with travel, but they're getting tremendous increases in their pay for that. So I think that's the one thing, like you don't really take back wage increases, right? They typically are permanent. So that's the one thing that I think is different now than it's been over the last 10 years. Everyone's been calling for rising rates for the last 10 years plus, right?
Yeah.
But we haven't had that inflation kicker. But inflation has been very low relative to historical levels over the last 10 years. Now we have this inflation. If it is not transitory, I can't see anything but rates rising in that environment.
Almost has to.
In which case, being in real estate would be a good play, I think.
I agree. Yeah, and
Because I think Federal Reserve policy, from a government rate directive, may have a different opinion. You guys got to go with that. The Federal Reserve is, because the government's budget has a very big incentive to keep at least the short end of the curve down, to keep their budget under control.
right.
And because right now, if you figure you want to get some kind of real rate of return, you would think the short end of the curve would be much higher than a quarter.
Yeah.
And it's not. And there's no visibility to even thinking about moving it up. So,
Yeah. And there's not. And then, the other thing that I think about is particularly like this, the Fed absolutely controls the short end. The long end has historically been market driven by inflation expectations and future economic growth expectations. But they're also in that market because they have asset purchase programs and the Fed is buying bonds. They're active, but they're starting to taper that. So what's that impact going to be? They're not going to have that buyer in the market. So does that raise rates naturally? Then you also have, we just had a $1 trillion infrastructure. So we're just like throwing wood on the fire. And when does that start to bleed into?
We're a bank where I work, and one thing I'll mention is, we have cash coming out of our ears right now. It's kind of like I got a director that says it's hanging from the chandelier. People's bringing money in. And you would think rates on the higher end would go up for the reason you just said, but what's happened is there's so much cash, so we don't have any other places to put it.
Yeah.
So banks compete with each other and drive down the rate of borrowing. That's what's happening.
Yeah. So there's a lot of, this is really complex stuff, and I wish I had an answer for you of when this is going to happen. When I think about putting the portfolio together, I think about, okay, longer term, what's the right moves from a strategic perspective to get to our return assumption over the next 30 years? And I absolutely think, because we know what interest rates are now, and there's a very high correlation between your realized rate and what the yield on bonds are. Say, so the 30 years at 2, we have corporate bonds, we have mortgages, we had some other stuff. So we can get a little bit more than that, but that's what you're going to get. Maybe you get 3% over the next 30 years.
That's not going to pay the bills.
Right. So taking some of that and putting it into a real estate where you're, right now that's yielding 4%. You're probably going to get a couple percent over time. And again, it's more volatile. There's more risk in real estate than there is in a government bond or even a high rated investment grade corporate bond. But from a total portfolio perspective, that acts differently than bonds and equity. So it adds a diversification element. It adds some potential return and helps us increase our probability to get to our return assumption over time. So I absolutely, am an advocate, and I think we should do it.
We don't need to wait. We probably need to listen to the initial perspective, because we still have to have another discussion, I think, to actually invest in it, right? This is just kind of an overview, right?
So we already did the overview of the asset class. What I have for you is,
Overview of the manager.
yeah, 3 managers, and you certainly could vote today. It just all depends on if you guys are comfortable. You have a quorum, right? So you can make actions. But you could do that today. You could say, if you had your plan attorney here by, basically based on the recommendation of your investment consultant, that's part of your fiduciary obligation is to rely on people like Peter and myself to make decisions. And you're following a good process by doing an asset class overview and then a review of managers. So if you wanted to make a decision today, you could. You could also have the option to, can we get one of the, someone from the real estate to talk to us as well? So that's absolutely on the table. I have clients that do it both ways. Sometimes they don't want to talk to the managers. Sometimes they do. So it's just really a board decision. but you're fulfilling your fiduciary obligation by going through the process that we have done.
Okay. What's y'all's pleasure? I think, let's go ahead and discuss it unless you guys want to wait on Al. It's up to you.
Sure, I mean, I value what Al's opinion is too, but, I mean, he's not here and.
We need to get going. I don't know. I think what I would probably do is we'll listen to it, you know.
It's a good step for us to do. I don't think we should, I'm gonna.
We shouldn't be waiting.
We shouldn't wait too long. I mean,
No.
why procrastinate?
Yeah. Let's go ahead and listen to it.
So let's just go quickly through and show you the good news for the fiscal year here. So the total pension, page 13, we ended the quarter up to $12.748 million. So the blue line is the market value over time. You can see we're, you know, let's see, the low point was, you know, we're well over 50% from the bottom of that, you know, the bottom of COVID there. So it's been phenomenal recovery here. Our asset allocation on page 16 versus our IPS targets. So we're in compliance with all of our, you know, our targets and our allowable ranges. Nothing's out of compliance. We maintain a small overweight to equities, a small underweight to fixed income and cash. That's appropriate. That's fine, particularly given what is a relatively high return assumption right now. You know, most plans are at around 7. You guys are at 7.55. So no rebalance needed at this time. We have enough cash to at least cover the next quarter, I believe. I think at 9:30 we had 266,000 in cash. We're paying out about 175 each quarter, so we have enough to cover. So I appreciate Peter having some in reserve, but we don't need to call that right now. We'll probably need to do it next quarter, but we don't need to do it now. Page 19, just to give you a quick update on this is financial reconciliation, the ins and outs of what went in and went out of the pension. So the upper half is quarter to date. So we had 12.759 at July 1st. So we did do a rebalance. You approved the rebalance last quarter. So we sold some of our equities, both managers, added some to cash and to some to our fixed income. Contributions of 178,746. I believe that included the state monies that hit during the quarter. Distributions of 175,000 out the door. Management fees of 17,800. Other expenses of 16,000. Income of 60,000, and then a small capital depreciation of 41,000. So that got us to that number, 12.748. Then page 20, the performance, you know, for the quarter was fairly ho-hum. We were up net of fees just slightly, 0.02%. We did underperform the policy index a bit, but for the fiscal year, you can see that, you know, 23% gross of fees, 22.5 net of investment management fees, driven by you know, strong performance in River Place, who has most of our equities. We outperformed, and as well as Integrity did a really good job outperforming over the last year in a tough fixed income market. You know, we outperformed by over 1.6% over the last year. You know, long-term results continue to be, you know, for the last 10 years, fantastic, right? 11.58%. Gross 11.1% net of investment management fees, well above our 7.5% target. But you know, the 15%. So if you look at the equity policy under the 10-year line on page 20, you see our equities got us 15% annualized over the last 10 years. You know, one of the things that, you know, besides the fixed income part, and you know, particularly, you know, over the next 10 years, I think your expectations should be that our equities might not get us that much, right? That's above average. The 100-year average for the S&P 500 is roughly around 10%. So we've done 15 over the last 10 years. So it makes sense that potentially we're not going to do as well, given, you know, well, you know, and I agree with Peter, but, you know, you can't I don't think we're in bubble territory in terms of valuations, but we're certainly, you know, not cheap in terms of what's going on. The market is definitely pricing in good things. So, so we'll see what happens there. But I think it is part of the math when you think about potentially lowering our return assumption going forward. On page 21, just gets into the manager performance. So Anchor underperformed in a market. So one of the reasons we like Anchor is they tend to do well in down markets. Over the last 11 years since you've had it, they have a very high hit rate of outperforming when the market is down. This was a bad quarter for them. They were down 1.6 versus 0.93. Now, no one's going to be perfect, and bat 1,000 in any certain market environment. But I do want to let you know that was disappointing. And if we start seeing there's no change to that team, we still like them. But if we start seeing more quarters where the market goes down and they're not doing what we think they should, then we might have a recommendation for a change there. We're not at that point yet, but I do want to let you know that it's something that we wouldn't expect and something that we're keeping an eye on. River Place did fantastic for the year. You can see they were up over 5% versus index. A year ago, they had two very tough fiscal years in a row where they underperformed significantly. And I asked you guys as a fiduciary, I thought it was prudent that let's not fire them, but let's put them on a formal watch, just to make sure. And there was reasons why they underperformed. The growth stocks and the Microsofts and those large cap growth stocks had grown to a large part of the S&P 500. And these guys tend to stay equal weight, meaning they have the same amount of stock or other portfolio, around 2% each of their companies. But when Apple's at 6% of the index, Microsoft's at 5%, it's a headwind when those companies are doing really well. So what we said was put them on watch, and if there's if they underperform in an environment where those large cap growth companies are not in favor, well, we have a problem there. But what we had last year was an environment where those companies were not the leaders, and then River Place did exactly what we would expect. They outperformed in that environment. So that was a good thing. So I think you can, formally take them off watch. They did well in the market environment where we would expect them to. Like you heard, there was no change to their team. It seems they're pretty stable. So I don't think there's any reason to keep them on watch going forward.
Okay, I agree with that.
And then Integrity, not much in the quarter for you. But for the 1 year, they did, they were up 1%. The index was down 0.4. So protecting your capital in a rough fixed income market. One thing about the inflation thing that I'll mention. So we've always been conservative with your fixed income allocation. This is managed to an intermediate bond, not a core bond. So they're only able to go up until maturities of about 10 years. So they don't own the 20 or 30-year maturity bonds that are most exposed to interest rate risk. So if rates rise, those bonds will get impacted the most and negatively impacted the most. So we're in a conservatively positioned, which is appropriate. I'm actually going out to my clients that aren't positioned like this. If they have an aggregate mandate, I'm recommending them all switch to an intermediate mandate, just because I think the risk reward of that right now just favors. That's particularly for a pension fund that tends to have more equities. Let's just be real conservative with our fixed income, and you guys are already doing that, so it's all good. So that concludes the performance review. Do you have any questions about anything?
Just a great year, and I think the message is don't get used to it.
Yes. And these are gonna happen. These results, the last 10 years, the one thing that I'll just state is that we are, we definitely have more equity than most pension funds because we have had a higher return assumption, but we're not taking undue risk relative to what our goal is to get the kind of results that we've experienced over the last 10 years. But you're right, we should not expect that over the next 10. It's just not.
From an actuarial perspective, the fact that we're overachieving lowers the city's contribution somewhat, but there's some smoothing.
Yeah, but yeah, and I don't know if you do a 4 or 5 year smooth, but either way, you're dropping off a 13% year, roughly. Both ways is roughly the same, and it's in here. But you're dropping off the 13 and you're adding 23. Again, there's some math that you got to average that, but net, it's going to allow you to lower your return assumption more than you would otherwise without impacting the city, which is a good thing. A lot of, one of the things that you might want to consider that other of our clients are doing is telling their actuary basically, use the return assumption, basically solve for the return assumption that gets us to a cost neutral basis for the city, meaning that whatever, we're going to set the return assumption for the valuation so that the city is unaffected, but that's naturally they're going to set the return that's going to be lower because you're going to benefit from these. So instead of, usually you'll just say, use 7.55 or 7.4.
What's the state?
They're down to 6.8. So they were at 7, now they're at 6.8.
Lowered it again?
Yeah,
I didn't know that.
yes.
Because before we were at 8, and then they lowered theirs to 7.
Yeah, we're just not quite on the same track they are. We're all going the same way, but
Yeah. Well, I mean, eventually they're like, well, hold on, man, we want you to.
well, they write a letter. Yeah.
Yeah. And you did a good, I mean, you were at 7.75, so you went down to 7.5. That's, they'll send you a letter and they'll send your actuary. Every 3 years, they formally review your valuations. And they say, we'll accept them. And they usually always accept them. They'll send you a cover letter and say, we think your return assumption based on our capital markets should be between 5.5 and 6.5. They're sending that letter to everyone. And that's just, it's like a nudge to remind you to continue to lower it, which it's a prudent thing given to what we know about.
It's difficult for them to get real aggressive past couple of years. But,
yeah, absolutely. Yeah. So,
but when the correction comes and we have a 3% return year, well,
yeah,
that'll be when the nudge will become more of a shove.
it could be, yeah. But there's also things like in other assumptions that, so I believe the mortality assumption, the state made a law like you got to use our mortality assumptions. You can't use your own. So I think some actuaries are just worried about them continuing to
Mandate.
Yes, and you don't want to get to a point where you guys are at 7.55 and the state says you got to be what FRS is. And that's a real big impact in 1 year if you had to go down to 6.8 from 7.55. I mean, that's a lot of money that the city would need to do. So
Because the city
continue to do it.
If you lower the assumption, they have to pay more.
Yeah.
All else
I
equal.
don't know why it confuses me.
Well, think of it this way. If you're putting money into a savings account, but you're trying to get to a goal, if you're earning less interest, there's less money going in there. So you got to put more of your own money in there to get to your goal. That's the way it works.
Because your liability is set. It's based upon what you, I don't know if you have a bargaining unit, but however you determine, how much you guys are going to get a benefit when you retire, that's set. Like that the city has to pay that. It's a legal obligation, but it matters what's the timing. So if you, as part of the math of the pension is you make assumptions about what's going to happen in the future, how many people are going to pass away, what wage increases are, and then what you're going to return on your assets. If you assume that you're going to get lower return on your assets, then that just means that you got to put more money in now to fund that liability. Yeah.
Yeah. But the other thing is it's not only return, mortality assumptions people keep living longer.
Yeah.
Regardless of the city's assumption, if they live longer, we got to have the money there to pay it, So just that number keeps moving out as well.
The only thing I ask is, in 13 months, I'm going to enter the drop.
You want a high rate or
Can we keep doing this year the whole time I'm in the drop, please?
We're going to do our best.
Try to be fun.
Yeah, that'd be
Any other questions about the performance review before we jump into real estate?
I don't.
So I'll try to give you the quick version of this. So if you go to page 2, you can see the 3 managers. And just to remind you, we have a dedicated research team that spans across asset classes that monitors and researches. Investment managers go through a very thorough process, on-site visits, multiple internal reviews, presentations, a lot of analysis. And these have all been fully vetted, approved for clients from ANCO. So we have American Realty, Principal Real Estate Investors, Stockbridge, Foreign Value Advisors. Page 3 just gets into, why are we looking at core real estate? We've talked about this. I'm not going to spend a whole lot of time going through this because I think we all understand that part. So go to page 6. This is just an overview of each of the firms. These are pretty large firms that are basically focused on real estate, American Realty, based in California, LA. They have over $10 billion in assets. Principal Real Estate, that's a subsidiary of Principal Financial Group, an insurance company. They're a very large player in real estate, over almost $60 billion in these private real estate assets. Not just this product, but I'll get to the product information, but just their whole real estate platform, based in Des Moines, Iowa. Then Stockbridge is based out in San Francisco. They have $9.4 billion in their real estate platform. And then you can see, well, staffed, these are not just mom and pop. These are very well staffed, have very, broad investment teams, and both from a kind of deal flow, from managing the assets, because all these funds are core assets, core real estate funds that are managing. We'll get to the geography and the types of properties, but they're well diversified across property types. They're well diversified across geography. So these are national funds in major markets. So you want, appropriately sized teams that can handle the types of the broad mandate this is. And page 7 gets into that. You see American Realty, 24 asset managers, 11 acquisitions, and a researcher. Principal, 53 asset managers, 16 acquisitions, 6 in research. And then Stockbridge, 17 asset managers, 11 acquisitions. And then their asset managers also perform some research too, so they don't have it real dedicated. But the most important part are the asset managers and who's doing the deals and finding the acquisition team. Page 8 gets into summary of the actual funds, the core funds that we're looking at here. So American Realty, one good thing, besides Stockbridge, which is a relatively new recommendation from our firm, all these funds incepted well long, they've been through multiple cycles. They've been through the financial crisis and the mortgage implosion of 07 to 09. Even Stockbridge, while this fund is only 2011, the principals have invested money elsewhere before they started this firm, but they lived through those cycles, which is why we have confidence. And even though this fund doesn't have that track record that goes back that far, the people that are managing that fund have experienced multiple cycles, multiple real estate environments that they can draw upon when they're going through, and appropriately positioning the risk of the portfolio now, where we're in a pretty good real estate market, to make sure that we don't kind of have some of the issues that we experienced back in 07 to 09. But you can see American Core, this fund, $7 billion, 67 properties in it. It's currently occupied at 92%. One of the core tenants or the characteristics of investing in a core fund is it's really based on income generation rather than capital appreciation. So the occupancy rate, you want to see it, above 90, because, the more value-added, riskier areas are where you can get some really good returns, but that's where you're hoping for capital appreciation, because those, it might not be, there might not be any tenants in it, and they're just hoping to improve something to get people to go live there or put their office there, or whatever the case is. The other aspect, leverage, is important to know. These are core funds. Real estate all does have leverage, but these are very well, conservatively positioned. All of them are below 30%, and American and Principal are both below 25 right now. And I may have mentioned this in the asset class overview, but if you think about your own mortgage, right, you're actually 80% levered. You put down 20% equity, you take a loan out for 80% of the property. So that would mean you're 80% leverage. In this case, they're putting down 80%, 75, 80% in equity, and then taking a loan out for about 25% of the property. So that's conservatively positioned, and particularly given the long dated nature of these leases and the stability of the cash flows, you can you can put some leverage on this to enhance your returns a bit. But these are all prudently levered. I think that's one of the key differences in some of these funds versus what happened back in that 07, 08 time period when there was overly levered and they were basically, got really impacted by that. So I think that was one of the lessons learned. It's good to see that. 9 gets into key differentiators. And, a lot of this is the same stuff, so there's not much differentiating. They're all investing, broadly diversified portfolios across the 4 main property types. One of the things you'll see in American, they like middle market assets, major markets, and top tier secondary markets. Principal has a little bit more in secondary markets and suburban areas versus kind of the urban large cities. And then Stockbridge has also an emphasis on middle market, upper middle market as well. And then they have a little overweight of industrial and multifamily and underweight office, which is probably a good thing right now. Principal has a similar positioning right now. I talked about the leverage point to consider. So American and Principal both are either average or below average leverage. The Stockbridge one tends to be a little bit above average. So that's something that you should keep in mind and will affect, I don't know if it's coming across, but I like Stockbridge, but for us, given it's our first entry, it probably wouldn't be my top choice to recommend just because it does have more leverage. It's a little bit more risky. And I think you'll be, well served by one of the other 2 managers, given the lower risk kind of level that they're taking. Page 10 gets into terms. Contribution queue, one of the things, the liquidity profile of this, if you remember, is different than investing in your equities or fixed income. You can invest your money the next day and buy stocks or bonds. Here you got to wait because they got to buy buildings. So typically for a core fund, it's not too long. So you can see if you selected American Core Realty Fund, you'd have to wait about a quarter to get your money to work. Principal, I just actually followed up with them and it's not provided, but they actually don't have a queue. So we should, if we invested it, we should get it invested that next quarter.
And then does any of these provide any ongoing cash flow out? Do they distribute or does it just all stay there?
No, so you have an option to, you're getting about a 4% yield and it'll be in here, we can get into that. And you can either get that and flow it into you get a distribution, or you can reinvest it just like you would reinvest in a dividend reinvestment in a mutual fund. So it kind of depends on, what you guys want to do. Typically, if you think about it, your return expectation would be higher if you reinvested that dividend just like you would reinvest in the stock market on a systematic basis. But if you do have cash needs, we have some clients who say, hey, we want that money. So they'll just wire it to your custodian on a quarterly basis. So we can determine that later.
And I would think this is minimum, you can make additional investments, probably what, $100,000, $250,000.
Yeah.
Okay.
And yeah, this is, we're not going to have a problem with any of the minimums. So you can see the fees are all pretty, about 1%, 1.1 for American and Principal, and then 0.95 for Stockbridge. Same thing when you take your money out, we see redemption terms. Typically, you would have to wait a quarter in normal markets. You put a redemption in and say we want to draw out 100,000. They give it to you the following quarter, but all of them will always have a mechanism to turn that off in weird markets. So everyone last year put up their redemption queue, and you couldn't get money out. And it's really to protect current investors. You don't want to run on the bank where everyone tries to get out the door and they have to start selling buildings. So that's very much a protective feature that we, is something for an institution that you want in place. But we might get in a situation down the line where we might have to wait a little bit to take some cash or rebalance. So 12 and 13 gets into where these guys are investing right now. So you can see,
Which sector office would be just regular multi-story office buildings, but how about things like shopping centers? That'd be in retail.
that would be in retail.
So that's both centers and standalone. Okay.
Correct. And most, so I'd have to double check on Stockbridge. American and Principal don't have malls. It's all kind of grocery anchored type of really nicely performing types of retail.
How about freestanding, is it, fast food, that kind of thing? Do they have any of that?
I'd have to double check on that. I don't know.
I think in both of those cases, the reason I'm asking is consumer preferences has really changed. You know, so
Yeah.
as long as it's not a material part of what matters.
Yeah, you know, I'd have to double check to see if they, I don't have a recollection that they're owning a whole lot of like McDonald's and things. So a lot of times that, yeah, so I'll double check, but I don't think they have that type of exposure.
In the office, you know, people are not going as much, but I think it's still too soon to know that. Peter, what are the people in your building? Is your building mostly empty again, or is they still people over there?
No, it is people are beginning to come back, but I would say it's probably still 50% pretty much out.
And it really doesn't matter if it's empty, it matters if they're making their rent payments, but
Yeah. Well, that's really important point, right? So
yeah.
The percentage of rents that are being collected in office is well over 95% right now for all of these guys. And
But if nobody's there, you got to think that at some point
the leases,
people's going to try to back out of the lease at some point.
well, it's really, really cost prohibitive to do that.
But all leases
unless-
expire.
Well, that's true. But one of the things that I think you're right, we don't have the data yet to support what the trends are. We know what the headlines are about office and back to work. But all of these funds are leased out right now in their office portfolios, 6 years on average. So they have a little bit of time to kind of react to what's going on in the market.
So some of our centers, what we're finding out is when you may not have as many people coming in, but you're still going to have people coming in periodically. So what you do is instead of having cubes, you may have more conference, you reconfigure.
Yeah.
But you're not really giving up that much square footage.
Yeah.
It's kind of interesting. It's not what I would expect a year ago.
Yeah. Yeah, and there's not, I just talked to Principal and I know our guy talked to American, they're just not seeing, asked them, I know you're leased out 6 years, but the small part of your portfolio that did come up over the last year, are you seeing much difference in, either a request for reduction in square footage or whatever the case is, or just not, and they're just not seeing that yet. So it's
kind of interesting, it's regional too. You get to land like Alpharetta, Georgia. Up there, I got people calling me, hey, you want some space, I mean, you ride around and it just looks like, it got carpet bombed.
okay.
But Jacksonville, on the other hand, not so much.
Yeah. Which is important when we get to geographic, is to have a diversified portfolio and not have kind of a niche strategy. You see on page 13, these are all well diversified across, the country.
For those that don't know, Alpharetta is just the high-end district of Atlanta. So.
And then 14 gets into the types of markets, and we define these if you want to look at so gateway, or there's, that's a formal definition. That's Boston, Chicago, LA, New York, San Fran, and Washington, DC. And secondary markets are, you say secondary, but these are the 15, let's say 20 largest metropolitan areas in the country. So you can see the vast majority of both of these funds are in the top 20 metropolitan areas of the country. And with, other markets being, much more for Stockbridge, almost 18%, but less than 10% for American Principal. 15 just shows you, these are mostly stabilized. All funds will have a little bit of flexibility to do some value added things. So they'll buy a property and try to build it up and then sell it or rent it out for more than it was getting before. that's typically going to be less than 10% of a core fund. So primarily stabilized, which are, leases of 75%. Plus, and you can see, I talked earlier, these portfolios are actually 90+% leased right now. So much higher than that 75% cutoff. 16 just shows you, the size of checks that they're writing. And it's mostly just to show you, they're not much, and I say small, they're not really dealing in sub $25 million type of properties. These are mostly 25 million or up, and the majority of our very large properties of over $100 million. And property age allocation, you can see again, diversified here. One of the things I like about American is that it is younger. It has 33%, a third of it in less than 5 years. So they don't have to do a whole lot of upkeep. If you think about, older buildings, naturally wear and tear, naturally putting new things in that might, say you own an office building, and you don't have a retail center. Well, you probably want to do that at some point because it helps attract people to get there. If you have a Starbucks, you have somewhere you can eat at the bottom of it. So things like that, Americans kind of taking care of that. Principal, not too bad at 22%, but that's definitely an advantage for American. And again, this is a repetitive theme, but the next page is lease expiration. Again, you just want to be diversified. You don't want to have all of your leases coming up in 1 year. So you want that spread out. And you can see all of these have, the most is 16% in 1 year. So it's very well defined in terms of when these leases are coming up. And then we can get into numbers for results. So you can see page 20, this shows you the income return that I talked about. So you're getting a 4% cash yield income return on these funds, which is very attractive as an alternative for fixed income. And then you can see the calendar year returns for each of these funds for the last decade or so. It's been a very good year. Up until 2020 when COVID hit, it's been a really good environment for commercial real estate. Fast forward, so this is a little dated because I brought the one that I did before. But if you look at the returns for the last year, I mean, the last 2 quarters that weren't in here for real estate have been really strong. If any of these funds, it would have been a great time last year if anyone would have let you invest because no one was really taking money or giving money out last year. But you're looking at the index was up like 14% plus over the last year, which was obviously a very strong return. Now that we're not going to get those types of returns, I do want to set your expectations. We're probably not going to get what we experienced over the last 10 years, which you can see on the next page. You can see the trailing performance. American at 8.3, principal at 9.5. It's been a great environment for real estate. It's not going to be that going forward, just like any other asset class. But if you can get 6 to 7% for this going forward, particularly as the source is that fixed income, where we think we're going to get 3. It's an appropriate, and you're taking a little bit more risk here, but that's certainly an attractive risk return for an asset class that not only provides a good return, but also provides some diversification benefits and inflation protection characteristics as well. And then, so that concludes the whole overview of the managers. We have I'm not going to go through these, but if you wanted to read more in depth about the teams and the strategies being in place and our expectations on these funds, we have kind of 1-page overviews of each of the managers. So do you have any questions about anything you heard?
I don't have any questions.
Are these investments, are they like, you give them $1 million and they put it to work, or is it a commitment and they draw it down as they need it, or how do they?
Yeah, no, so this is open. These are all open-ended funds. So you put $1 million and you get $1 million worth of the total fund, and you're generating that right away. Yeah. Okay. So the other mostly for new development and riskier types of investments, they're called closed-end funds. So they have a 10-year life, and they raise new funds periodically. And then you say, if you gave them, let's say $1 million, they might call, as they get deals, they would call, give us 150,000 so we can buy this building. And then 6 months later, we need 200,000. That's not what this is. This is open-ended funds that once you put that money in and it's accepted, because it does take a quarter sometimes, to get it in the door, but you're in and you own a pro rata share of the existing buildings that are in the fund, and you're up and running.
On an ongoing overview perspective, what should we expect to get from any of these to, to evaluate the investment over time?
In terms of returns,
No, I'm talking about, okay, here's the returns. It's valued by the street. I know that, but I'm talking about, do they provide ongoing kind of investment information, know what's going on?
yeah, so we get quarterly summaries and our research team is on it. I will be, these guys are probably not going to be as good of a client service as Peter is in coming to your meetings on a quarterly basis. But they would be periodically available if we wanted to set up and you're interested in doing.
They probably do a Zoom call or something.
Yeah, they would be happy to do that kind of thing. But yeah, so on a quarterly basis, they provide full kind of quarterly updates on each of the major property types, what they're doing, what the transactions are. In terms of how, it's a good question about how the stock market values what's going on in Peter. How are these valued? So these are private properties. These are not publicly traded. So, but they do have third-party independent appraisers that will go in and provide an appraisal of each of the property, and it's based on basically transactions that are in the market. So they'll look at say Boston, in the Boston metropolitan area, they own this building, has a certain square footage, that has a certain type of
discount cash flows and all that.
Yeah, and so they'll do comps on that, and that's how they're valuing these. And then so that's an unaudited quarterly, and then annually they're doing a full audited version of that as well. So and again, this is not them just selecting the prices. This is a third party.
Page 10, talking about ERISA fiduciary. I know we're not an ERISA fund. What would Stockbridge have that make them not an ERISA?
It just adds a certain degree of liability that some private investors are not comfortable taking.
Okay. I'm just trying to think what makes you an ERISA fiduciary or not an ERISA fiduciary?
I don't know the technical, that would be a legal question.
Right.
But it's, yeah, I know just, most public equity managers will say yes to that. And you can see some of our private ones do, but we see it more on the private market. Some, they don't want to just have that scrutiny and they're not willing.
I appreciate that.
Yeah. We include it because we do have a risk plan. So it's just kind of in our stock portfolio, or our stock presentation.
So what's your recommendation, if I recall? If I recall, it was move some dollars out of the fixed income, or this?
Yeah, so our target is 10%. So we would take, at 9:30, it was we were at 13.7. So we would put $1.37 million into one of these funds. And my recommendation, and I like American in principle more than I like Stockbridge for the reasons I said. Stockbridge is a little bit more risky. There's some benefit to that. We might be giving up a little bit on return there. But I like the American fund. I use that I use both of these funds and other clients. And it's really close. It's hard to pick between them. If I had some factors that I like for the American fund is that they do have that newer portfolio, which I think might be beneficial going forward. What was the other part?
Just look at this is not the American funds group. This is a different group.
That's correct. This is
Yeah.
Where will we pull 1.3 million from? Integrity, Anchor, and Integrity.
Yeah, so if we go to So our total fixed income target would go from 30 to 20. That's how we build it in. So the target would be all coming from fixed income. But I don't think we should take all the money from fixed income because we're already underweight. So we're at 25%. So if you think about it, I probably would want to do probably 75% coming from fixed income, but I would want to draw some from the equities just because it would get us more in balance with our targets.
So are you, and then you'd pull obviously the balance from the equity perspective.
Yeah, so if we did, I'd have to do the math, but let's say.
Whatever the math is fine.
We did.
Ask you to do the math on the fly.
Let's see if we did 80% equity, so that's 2. Yeah, so it would be, for 1.37, we would do about 1.1 from fixed income and the about 250,000 or so from equities.
Okay. So I think we only have enough dollars to do one or the other. So you like an American, so you're like it, I'm thinking.
Yeah, so we can only pick one just because of the amount of money that we have. And while we have some flexibility, probably around that million they probably are not going to take 600 grand each. Yeah.
Much trouble.
But yeah, so I think, and again, it's really close. And to be fair, Principal has done better over the last 10 years than American slightly. But I think, going forward, given the newer buildings, I'm kind of splitting hairs here,
Given the fact that Principal's got a bunch over 20, they're going to be facing some, and they probably are incurring as they go along, but still.
We were thinking the same thing.
Yeah.
Both of us. So
That's first thing I told Adam was 40% of their buildings are 20 years old.
Yeah.
And then there's another 20% that are in the next category.
Oh, yeah, so they got 67 that's over 10, so they're gonna have more expenses. How long would you, if you gotta go into this,
bigger fund.
how long do you think a particular is the life cycle of a particular real estate investment firm? In other words, how long would you stay with American? I mean, as long as they're performing, or is there a life cycle to it?
No, yeah, I mean, and particularly, these are core, so they don't buy and sell buildings. They do some portfolio management on the end, but if they buy some, they're usually holding it for 20 years. So yeah, unless there's a change to the people that are running the fund, or sometimes, your thesis gets wrong, just like with any investment. If, we make the wrong call and being in the whatever office properties or geographies just don't work well that could change our opinion. But if we really think about this, would be a very long-term holding.
That's what I was getting at. You won't look at this like a stock play for 5 years and you have a different opinion. This is
No. Again, we monitor this on a quarterly basis. So if the principals that are pulling the trigger on buying the buildings, there's a mass exodus, well, we would tell you, guess what? You probably want to consider maybe go to Principal if you select American and vice versa.
So what's y'all's guys' opinion?
I favor American.
So I'm hearing you. So it's in your favor, that's your favorite doing it. So the first
I mean,
thing is,
if Anco thinks that's the route we need to go for
Yeah.
stability, then
yeah.
we have.
Well, I'm the reason I was quizzing more than anything thinking about fixed income. I'm, as you know, in the fixed income business, and I think returns for the next 5-7 years on a real return basis, fixed income are going to be very difficult. Now, you may have some inflated numbers go through a period of inflation where it all kind of bums up. But when you subtract the inflation rate, I don't foresee a lot of real return. These guys are able to get real estate by its nature tend to get real returns because they're just going to raise the rent.
Right.
And most of the time they have either triple net or rental agreements that provide it follows the rate of inflation. So if they were ahead of it, they're going to stay ahead. So which is a little different than a fixed income investment. So I'm for it as well. So if you guys like them.
You feel this is a pretty safe one.
Yeah, I mean, none of us can predict the economy of, if everybody starts working from home and nobody needs office buildings and we all start buying everything from Amazon, you never step foot in a mall again. Well, then these things are going to roll off and be but real estate tends to be used for something, you know? I think I saw where in Jacksonville, Peter may know this, but one of the dead malls over there is being turned into an Amazon location where everybody kind of drive up and pick their Amazon stuff up.
Yeah, there's,
But they get repurposed, is what I'm saying.
yeah, a lot of the malls they're doing some interesting things. Some of them are, turned into offices, which I always like, how do you, a mall is like cavernous, like,
Well,
going to
Gainesville, I went there, the Oaks Mall in Gainesville is turning into a Shands Hospital facility. They have this big, huge,
Is it really interesting?
they have this, well, not the whole thing, but they have this, where Sears was at, and there's a couple other people met in, maybe been over there. They've turned it into their eye and ear place for Shands.
Well, it's been that long.
You need to write, I mean, you'll be surprised. I mean, they probably spent, God knows how much money on it. I mean, it's like you go in there, it's like state of the art,
Wow.
but it's,
But I bet you they bought the building pretty cheap because Sears went bankrupt, so
Yeah.
they probably got I'm sure they had to do a lot of changes to make it.
oh yeah, you wouldn't even know it, but it's just, it's a huge cadaver, huge medical facility. So seriously, next thing.
That's a big shelf space.
Yeah, but when you think about it, turn around, right, look, it's by there in the corner, you wouldn't ever know it's there unless you rode over there. So I'm okay with it. So, and I'm okay with your allocation of who these guys are, about how you get the money. So,
Yeah, so this would require a motion that be passed, and I would recommend that, do you guys use Bonnie? Do I remember? I know she doesn't come to meetings, but you should get her to review this. So you should approve an allocation, a 10% allocation, because we'll make sure.
I was gonna say the contracts, there's gonna be a contract, I'm sure.
Yeah,
We'll
so-
send it to her and
So approve a 10% allocation to American Realty Fund using 80% fixed income, 20% equity as the source, subject to a legal review by your counsel.
sounds good.
Or did you get all that captured?
I got a
I think some other
motion,
people's trying to have a meeting out there, so we gotta get going.
motion made, to approve 10% allocation to American Realty, subject to approval.
About legal counsel.
And the source of it will be, we'll take 80% from our fixed income manager and then 20% from our equity, split between the two equity managers.
Good.
I'll make a motion. I'll
Who
second it.
made McDaniel?
Call for vote. All in favor, say aye.
Aye.
Any opposed?
80% fixed and 20% was
Equity.
equity.
Equity, and then we'll split that.
I don't think we have any open discussion items.
I only have one thing to bring up.
Okay,
The drop money for our drop applicants, which one is out now, which is Jeff McNeil.
I'm sorry, I can't hear you.
The,
Heard about drop, but that's
We were trying to figure out how to get
a
a
statement.
quarterly statement to the guys that are in drop. Well, it still hadn't happened.
Okay.
And I
I need to
don't
be more
know
aggressive.
who to call or what.
Because I thought, last I thought the actuary people was gonna get the information and do it periodically.
Right, but I think the actuary people knowing about it and where to get info from didn't happen. I think it's what's happened, but
Or do you wanna,
Were they relying on the finance director to provide them with some information?
probably.
Mona,
I have to look at the,
But
can you maybe, after the
I'll
fact,
revisit the email.
we only have one in it now, so. which
well, we
is
need
why.
to have a system, and we need to give them a first statement.
And it could be just an email sent to him every quarter, I don't know.
Why don't we do this, Laura? After the meeting today, set up a phone call with me, Donna Duncan, the city finance officer, and people in the actuary, and probably Mike Tierney or whoever he wants to do. And let's just get to the end of this. And if they can't do it, that's fine. But we need to come, then we need to be looking for somebody that can.
I was thinking if we can make it a normal thing too, so we got
Yeah, they just need to.
people enter
just
the
need to be a
draw,
statement.
it'll just be an automatic thing that they get a statement
Yeah, I don't
every
know,
quarter.
maybe because they don't have an HR director, because there
Yeah.
was like McNeil, I didn't even know, I mean.
You know, yeah, no, the city right now, half the people don't work there right now.
I put his wife in touch with Donna, so I think they were getting it taken care of.
Yeah, let's just schedule something. We'll get it handled. And if you want to let them know we're having a phone call, we can do it by Zoom or something. So if they can listen, but they can't talk. That's it.
But I think Don spun it and DJ.
Okay.
Okay,
Well, I'm sure.
anything else? I think I'm trying
in the
to, I think somebody else needs to remember the list.
Yeah, we'll make a motion to adjourn.
Can we,
Oh, sorry.
Yes, sir.
at the next meeting and just.
Oh, okay.
We're gonna-
Sure.
This was a little bit off our schedule because last week was Veterans Day.
Yeah,
We're gonna stick to the second Thursday of,
That would be February 10th.
so it'll be, yeah,
Yeah, I've got it on my calendar. That's good.
we'll do, it'll be 2/10,
22.
May 12th.
I got it at 10:30, more, are you sure? I can change it, but we put it at 10 a.m. We'll put it
10:30?
at 10 to 10:30. But I,
Whatever
doesn't really
works for you
matter.
guys works for me, so.
Yeah, 30 minutes is never long enough.
Yeah,
It's fine.
But I think David's saying that the start time was 10, you had it,
at 10, yeah.
start time 10, so
It doesn't
it's up
really
to you
matter.
guys.
That's up to y'all. I don't know.
We did 9:30.
9:30 is fine.
9:30 works for me.
Yeah, we're good. All right, that's it.
So we're gonna keep that same schedule for
Yeah.
2022. Okay,
Yep, yep.
9:30.
all right.
Anybody got anything else? Anybody from the audience has anything else? Going once, going twice, we're gone. Thank you.